$6,000 deduction. Absolutely. Let's click consent. So automatically can get a $6,000 deduction off the top. So what does that mean? So how is it going to work in your software? The way it's going to work in your software, and I just want to take a few seconds to pull this up over here. On that actual main information worksheet, once you enter in their date of birth on the main information worksheet, automatically that $6,000 is going to be added. It's going to trigger a form called Schedule 1A, which we're going to go through Schedule 1A in full detail here later on in our presentation. And once you enter that date of birth inside of your tax solution, it's going to automatically kick in that $6,000 deduction. That's going to be there for you, right? So just be mindful of that. Something we're doing inside the software to kind of automate the process for you inside of TaxWise. All right. Now there's some phase outs that are taking place because you've got some retirees. Yes, they may be retired, they may be seniors, but maybe they did well for themselves. Maybe they saved a lot of money or something like things of that nature. They did a lot of things over there. They saved a lot of money or they invested a lot of money. So they're getting pretty much higher than their Social Security. They're getting their pension and some other income items they may have. So for married, filing jointly retirees, clients that are over the age of 65, I shouldn't say retiree because there's plenty of folks that are over 65 and still working. But if they're married, filing jointly and their income exceeds $150,000, they don't get the $6,000, right? It starts to phase out. Now, this is only in effect for 3 years. So 2025, 26, 27, 28, 4 years, up to 2028. So for those 4 years. So, there may be some, as Congress moves along in these next, 3-4 years, we may see what may happen with Congress. But it's good to be able to take advantage for your clients for this upcoming tax season. Now, if they're single, so it's just going to be $75,000. There's no head of household or qualified widower. Well, qualified widower does be able to benefit for some married, filing jointly statuses or some things they could benefit for that. But you notice it's in between whether they're married, filing jointly, or they're actually going to be single. All right. So we're going to go through that Schedule 1A in just a brief moment here. So in addition to that, what else is coming, right? And this is the big topic. This is the big topic over here. No tax on tips and no tax on overtime. Now, when you hear no tax on tips, you'll actually think, oh my goodness, right? There's no tips are being taxed. Absolutely not. Now, some of you are in a beautiful position where you live in Florida, you live in Tennessee, you live in Texas, you don't have state income taxes, and there's a couple other states that don't have state income taxes. I think Washington is another state, they don't have individual state income taxes. However, me, I'm outside of it. I live in Atlanta, Georgia, where there is a state return that we have to file. So just because you're seeing no tax on tips doesn't mean that the states are not going to be taxing it, right? So it's what we call, it's a fancy term. I kind of like the term. It's called decoupling. Decoupling, right? It's going to be a deviation, right? AKA an add back, right? So let's talk about this. Let's walk through the no tax on tips and what that looks like. So in this case scenario, and there's a phase that begins. So for the next 4 years, from 2025 to 2028, the first $25,000 of qualified tips will not be taxed. Now, where are you going to get this qualified tips number from? Matter of fact, let me see it. There's a W-2. If I was to pull up a W-2, if I was to pull up a W-2, I'm going to just move this over here for a second. There's a box 7, right, where it's the Social Security tips. So as workers are reporting what their tips are, do I have it in here? No, I don't have it in this one. But on the W-2, box 7, where it says Social Security tips, that's actually where that number is going to be at. Let me just see if I can pull it up real quickly. 2025 W-2 and pull it up over there. So that's a number that you're going to want to take into clear consideration, that particular number over here. I think I've got it. I'm going to pull it up here. And I'm going to show you, matter of fact, I'll just show you inside of TaxWise. Let's just show you inside of the actual TaxWise solution. So I'm going to pull it up here on TaxWise. But that first $25,000 is not going to be taxed. Now, if they make $150,000, it's going to start to phase out. Married, filing jointly, $300,000. It's fully phased out when the income exceeds $400,000. This is fantastic, folks. What you're going to see this year, you will see more and more clients pay less this year, owe less this year, bigger refunds this year. You're going to see that, right? And what this is going to come into is because of these deductions that are coming. Now, you don't have to itemize in order to get this. So if I was to go over here, if I was to pull up my W-2 on this worksheet over here, where it's going to be located inside the TaxWise, when you scroll down, you'll see it right down here where it says qualified, no tax on tips. Enter the amount of qualified tips in box 7. What's box 7? Where is box 7? Box 7 is right here, Social Security tips. So that's where the number from tips. So that's the number you're going to be looking into to consider, because that's where going to be that those tips are. So now some clients report their tips, some clients don't report the tips. I encourage you, right? Just remember we talked about you being a tax strategist, right? Strategically working with your clients to legally reduce their taxable income. What's going to happen is you want to encourage your clients to report all their tips. Why? What if that client's trying to buy a house? What if that client's trying to qualify for something, right? Qualify for a mortgage, something like that. Banks are going to be aware that there's a $25,000 haircut, a $25,000 reduction in taxable income, but as long as those tips are being there, so that can help boost the client's income. FICA and state taxes still apply, so there still will be an add back for some states. I just want to bring that to your attention. All right, so that's a hot topic over there on the tips and taking that into consideration. Another thing that we want to talk about too, we're going to kind of skip through this section for a second, is the overtime deduction, right? The first $12,500 of overtime income is not being taxed on a federal income tax purposes. So just like what you saw earlier on the W-2. Now here's the thing though, they were not able to. This is what the 2025 W-2 looks like, right? It's pretty much the same. Right? It looks the exact same as the 2024 W-2, right? However, so they didn't have enough time to adjust the W-2 to have a box for overtime pay. So when you're inside of your software, you're going to see over here where it says overtime compensation, no tax on overtime. This is where that's going to be entered in. So you're going to need to scroll down to the bottom of the W-2 to see that. Now, let me ask you a very important question. How are you going to know what the overtime is? How are you going to know what the overtime is? Right, I wish I could see you. I wish I could see your mind's thinking. You will need to ask the client. Number one, the first thing you want to ask the client is, do you get paid by the hour? Are you an hourly worker? If they say yes, they get paid by the hour. Like my mom is an hourly worker. My mom works at the hospital, right? My mom is always getting overtime. She's always working overtime, right? So since she's always working overtime, then in this case scenario, then you will need to, if you were doing my mom's taxes, you would need to ask her, okay, can I get your last two pay stubs? Not your last pay stub, right? Because if you look at how this year is going to go, the way how 2025 ends, 2025 is ending on a Wednesday. So since it's ending on a Wednesday, there may be some still pay periods going on until the 2nd of January, right? So you want to make sure you ask for the last two pay stubs is what you want to, the last two pay stubs is what you want to make sure that you ask for from your clients. And the reason why I said is because that's where you're going to see the overtime pay. When you see that overtime pay, you want to make sure that you enter that information in, right? So 9 times out of 10, if they're an hourly worker, they're going to have overtime pay. So let's think about this for a second. We got $12,500 being automatically taken off the top of having no overtime pay. We got another $25,000 that's being eligible for tips, right? For tips, right? So that's potentially a $37,000 in savings, depending on what industry the client's in. Now, speaking of industries, let's pull this up on the screen over here. Not every industry is going to be getting going back to the tips for just a second. It's going to be these industries, and this is good. This is the handout that you're going to be getting. You're going to be getting this PDF handout. So any workers in these industries, wait staff, bartenders, beverage and food services, entertainment and events, hospitality, home services. And I want to emphasize something. You're seeing personal services, right? Personal care, massage therapists, shampoo, tattoo artists, things of nature, hairstylists, etc. But let's talk about this. See where it says taxi right there? Ride share, right? How many of you got clients that drive for Uber and Lyft, right? And they get tips, right? So this, you would think now think about this. You would think that this applies just to W-2 workers. No, this also applies to the self-employed, those Uber drivers, right? They're getting 1099s, right? Hairstylists get 1099s as well. So you want to be a tax strategist. So you got a client that's a hairstylist. Let's say, okay, I need you to go into your POS system, or I need you to go into your system over here. Let's figure out what your tips are. Because you're going to be able to legally reduce $25,000 off their gross income based off the industry that they're in, right? I'm telling you, this is fantastic. So let's move along here, right? Because Alexis and Omar challenged me, thinking I'm not going to be able to finish my slide. So let's move on. So we got that going on over here. There's still going to be FICA and state taxes applying to it. We still got that going on over here. But all right. So that's for California. There's some rules around this. There's a little explanation that we have on how this is figured out. And the overtime pay, married filing joint, we got a little calculation, this example. Another thing to take in consideration, and I want to actually jump for 1 second. Since we're talking about cars, I should have kept these slides together. So there's a new above the line deduction. So you will be able to, for your clients, if your clients purchased a new car between 2025 and 2028, that means they will be able to deduct the interest up to $10,000 of interest. However, their gross income, right? If their gross income exceeds $100,000, the phase out begins. It starts phasing it out, meaning it's phasing it out based off of calculation, right? We don't have enough time to go into full detail out of it, but your software tax-wise will help you with the phase out, calculating the phase out. So if it's married filing jointly, it's $200,000. If it's single, and there's no distinction between head of household and single, so it's going to probably default. If they're not married, it's going to just default to the single status over there, right? So if you got your clients that purchased a new car in 2025, 2028, they're going to be able to deduct up to $10,000. You do not need to itemize in order to get this deduction. It's above the line. Now, there's some rules around it, right? The vehicle has to be less than 14,000 pounds. Another thing is the vehicle has to be assembled in the United States. Now, the good thing is many vehicles are being assembled in the United States. BMW has a big plan in South Carolina. Some Mercedes are being assembled in Alabama. And you'll be able to see with the VIN number and the certificate, it says on the door of the car and the certificate that you get with the car, whether the car was assembled, right? Because manufacturers are going to want to put that on there so that you can qualify for the tax deduction. I'm also starting to see on commercials. If you watch, I watch a lot of sports. You're seeing on commercials now, this vehicle may qualify for a tax deduction, right? You're starting to see that on commercials. They're saying that on commercials because of this over here. So I want to introduce you to your new little friend. And your new little friend, let's bring back up tax-wise here for just a second here. This is going to be your new friend. Your new friend is called the Schedule 1A. Right? I want you to, after this, I want you to either log into your tax-wise or Google it, Schedule 1A. I want you to know this form like the back of your hand, because this is the form where the modified adjusted gross income is going to come in here. And then it's what's pulling over. This is the form where your no tax on tips is going to be coming in here. So where you'll be entering what that number is, which is coming over from the W-2 and tax-wise. This is the form also where the no overtime pay is. So you will need to enter, well, that's going to be coming over. It's going to be coming over from the W-2 if it's an employee. But if it's an Uber driver, let's say it's a hairstylist, right? I'm sure many of you got hairstylists as clients, right? And you get them some good refunds or you reduce your taxable income. You will need to enter this because it may not be on the 1099 NEC, right? 1099 NEC is going to report a number. So this is the form you're going to come, Schedule 1A, and enter that information on what that actual overtime compensation is or what those tips are. So that's going to be on the Schedule 1A. Now let's go to page 2 of the Schedule 1A, right? Schedule 1A is your new friend. Look what we got here on the Schedule 1A, right? The no tax on car loan interest. You have to put the VIN number in. Only 2 vehicles per tax return. Right, so so just take into consideration. You can't go out there and buy 4 or 5 cars. Oh, I'm gonna get no, just 2 vehicles. Another thing to take into consideration. Look what it's doing over here. You need to enter the amount that's being entered in the Schedule C. So maybe your client's an Uber driver and they went out and bought a brand new Suburban or a brand new Tahoe. They're gonna be doing Uber XL rides or something like that, and you go and deduct the interest on the Schedule C. If not, the reason why this is here is so you don't double dip. You don't go in there and put Schedule C deduction interest on here and then come over here, put on the Schedule 1A. No, got to pick or choose. So this is where we talk about you being a tax strategist. So you strategize with your client. Where is the best place that this should go? Should this be on the Schedule C, or should this be on the Schedule 1A, or should we put a portion of it, right? Because after maybe you've maxed out all the deductions in the Schedule C, you need to carry some over here. So Schedule 1A is your new friend, is where these deductions are going to be at, right? Same thing with the $6,000 deduction for seniors. Automatically, that $6,000 deduction for seniors is going to kick over here once you put the date of birth inside of on the main information worksheet. It's going to kick out the $6,000 over here. All right, so that's the Schedule 1A. That's your new little friend. So total deductions over there, it carries over to the actual 1040 to reduce taxable income. All right, so car loan interest. And since we're here and talking about vehicles, I want to mention here on this to you Just going to jump over for just a second. I'm going to do a quick little jump on one thing. And I'm going to jump to energy. I'm going to come right back. And the reason why I want to jump to energy for just a second, I know I'm jumping, but I want to just go to this because this relates to, since we're talking about vehicles. Since we're talking about vehicles over here, let's go over to that energy section. All right. So September 30th was the end of the electronic vehicles, the EV credit, right? The $7,500 EV credit. September 30th was the end of it, right? So just want to let you know that. So you may have, so if you had a client that purchased an electric vehicle from October 1st up to December 31st, yeah, I could get a tax credit. Right? I heard I get $7,500. No, you're not getting $7,500 tax credit. We can deduct the interest. If you borrowed the money to purchase that vehicle, you can deduct the interest up to $10,000 if that vehicle was assembled in the United States. However, that September 30th expired, right? So we want to make sure we touch on that since I'm talking about vehicles. All right, we're going to come back to energy credits in just a second. Let's pop back over here and let's go over to individuals and families. All right. So on individuals and families, yep, there's going to be no longer any personal exemptions. So personal exemptions are gone. The standard deduction has increased, which we talked about. Child tax credit, that has increased. It's an increase around that. We talked about the standard deduction, and there's a higher charitable deduction that's coming for charitable contribution. That's going to be coming over here as well. So when it comes to the, big one, SALT, state and local tax, right? So for your clients that are itemizing, I'm sure you've got clients going to be itemizing right now, right? Because it's $40,000 now. So that $10,000 cap is gone for the next 4 years. So from 2025 to 2028, for the next 4 years, you will be able to deduct up to $40,000, and that's for single and joint filers, right? Now their AGI needs to be between, their AGI starts to phase out. So once their adjusted gross income exceeds $500,000, then it's going to start to phase out and completely go away at over $600,000. But for many clients, this is fantastic. Especially for those that do live in high jurisdictions, like if you live in like New York, California, LA, those type of areas, or maybe you have no state income tax in your area, but property taxes are higher. That's the case in Florida. That's the case in Texas and some other states over there. This is going to be a big saving grace to you, right? So you remember how I said earlier that your client's going to probably pay less in taxes this year. You're going to have higher refunds this year, right? These type of provisions, these types of things. So when you're itemizing, this is going to be available to your clients. All right. So that's the SALT deduction over there. Now, I wanted to make sure I put this in here because some of you, you're going to have clients going to gamble, right? I know there's some big, reservations where people go and gamble, Atlantic City, Las Vegas, etc. And I used to have a client every year. She always came back with a W-2G or 1099G or something like that. She always went to Vegas and won some money. And then we would, work to get those gambling losses legally reduced. However, you can't reduce them all, right? 90% of losses can only be deducted. So they want you to report 10%. So this is one of the ways that they're being able to pay for this bill because there's so many deductions that are coming in that are legally reducing taxable income. So, okay, gambling, we can't 100% offset gambling losses against gambling winnings, right? So 10% of gambling winnings need to be reported, at least 10% of that. All right, so bring that to your attention. All right. Also, there's been some things that have become permanent for armed forces. So the moving expenses has become permanent. Also qualified hazardous duty areas for combat zones. That also is going to be deductible as well. So just kind of that's also qualified as armed forces tax benefits as well, where it's not being taxed. So that's going to be something that's coming into the bill for those of you that have clients in military. All right, so the adoption credit, of course, the adoption credit that's coming into effect. So you have streets up to $5,000 adoption tax credits. That's going to be refundable. That's fantastic for those of you that are having to adopt, have clients that are having to adopt. So the first $5,000 of it is going to be refundable, and then you'll see how the other portion of it can be carried forward. So up to $17,280 can be carried forward into future periods. You can see that over there. All right, child independent care credits. Now, this is interesting. I actually have a chart. Here's my chart over here, and I want to use a chart. It's a little bit better on the chart. So on the chart, and this is interesting. So if you have a client that has an AGI of $15,000, right? Their AGI is $15,000, then that means that 35% of the, up to 50% of their child independent care expenses is going to be a credit on the return, right? It's not a refundable credit, but it's a tax credit, right? And this is interesting because if a client has $15,000 of adjusted gross income, they're paying very little to no tax. But anyway, so that could erode. And then when you factor in earned income credit, child tax, all these different things, it's yeah. But anyway, that's going to be up to 50%. But then when you get to $15,001 to $43,000 in AGI, now this is good. I like the fact that it's looking at AGI, because the adjusted gross income is kind of before you factor in itemized deductions and other things of that nature. It's before you get to taxable income, so it's factoring those items in there. So it's gonna decrease from 50% to 35%. So that means that what they're spending, what they're paying for summer camp, morning care, aftercare, 35% of it is a tax credit on the return, which is fantastic, right? But then when you get to between 43,000 and 75,000, you'll see 35%, right? That takes effect over there. So post the One Big Beautiful Bill Act, and then you'll see over there it's going to start gradually reducing as AGI declines. It starts reducing and phasing out down to 20%. And if their income's above, AGI is above 105,000, it's just going to be 20%. But this is good that there's going to be an increase in the child independent care credit. That's good, even though I still think, it's when you factor in all the other credits that you have for having children, this may not be a big factor. Sorry, that's my opinion. I apologize. But still, that's going to be an increase for that. So let's talk about the child tax credit. So child tax credit is going to be increasing by $200. I know $200 may not be a lot as being indexed for inflation, but still $200. If you could increase a refund by $200 is $200, right? You could do a lot with $200. But then the refundable portion now is going to be up to $1,700, right? It's going to be indexed, so it's going to be up to $1,700. Still income phase out, married, found jointly, $400,000, $200,000 for head of household and all the fathers, right? Now, big thing on this one, there must be an eligible Social Security number of the taxpayer, right? We know the child is probably going to have a Social Security number because the child probably was born in the United States, but of the taxpayer. So if if you're doing a married, found joint return, and one spouse has an I-10, the other spouse has a Social Security number, you put that Social Security number first, right? Let that Social Security number, the spouse with the Social Security number, let that be the first name on the return, and then you've got the other one with the I-10, and then of course you got the return, right? So at least one spouse you'll see must have a Social Security number for joint filers. All right. So I wanted to touch on this for 529s, just in case if you do have clients that are using 529s. The reason why I wanted to touch on this is because with the 529s, you can use it for other things now. Remember, they changed it a couple of years ago where 529s can be used for K through 12. It's not just for college, but also 529s. The funds in the 529 can be used to pay for SAT prep fees. It can be used for tuition for student tutoring. So maybe your client students are getting tutored. They can use it for that. It's not just for if there's some therapies for students with disabilities incurred. So it's not just for just straight, okay, paying tuition. There's other things that it can be used for. Of course, you want to make sure you keep proper documentation and notes for that as well. But you can use the 529 to go towards private institutions as well. So if your clients have kids that are going to private school, they can definitely use the 529 for that. And that's for tax years beginning next year. So that takes effect in 2026. All right. So I wanted to make sure I touch on that. American Opportunity Credit, not too much change on that. It's going to be pretty much the $2,500 eligible for student for the first 4 years of undergraduate college. It covers tuition fees and required course materials. So not much changes around that. But then you'll see lifetime learning credit. So up to $2,000 per return for unlimited years of post-secondary or job improvement courses, non-refundable, covers tuition and required fees for undergraduate, graduate, professional education. So this is fantastic because if your client phases out of and can't get American Opportunity Credit, they can use lifetime learning credit, but also for graduate school, right? If your client's, definitely going to get their master's or any anything after, their undergrad and they can't get American Opportunity Credit, the lifetime learning credit is available for them. All right, so that's going to be effective. That's going to be very helpful for them. All right. And they have to have a Social Security number if the student's claiming it on their own. Another thing that's happened too, and this is starting to become the trend. Now, how many of you have clients that are S Corp owners that have S corporations? And this is where I'm talking about being a tax strategist. If you have a client that has an S corporation, what does that client have? That client has control. They have control over what their wages are. They have control over their income. So this is where you working as a tax strategist can truly help them. So for instance, if you have a client that has an S Corp, maybe let's say their S Corp makes $100,000 a year and they have a student in college. From that, instead of them paying the tuition with after-tax dollars, they can actually put their student on payroll in the business, right? If their child is working, create a job, when they come home from college, they organize work paper to do something, whatever, for their business. And then you could pay up to $5,200 and $5,250 towards their actual college. Or maybe you've employed your dependent, your child, through your business, and maybe you're an S corp owner. $5,250 could go towards their student loans. You can pay that towards your student loans, student loan reimbursement. So these are ways that you can definitely use your S corporation to be flexible. It's where you're strategizing with the client, right? $5,250 to reduce. Mind you, reducing taxable income. So let's just say they're in the, I know I'm being a little bit, and I've got about 10 minutes left here, but I just want to be a little exhaustive on this here. And just talk about the savings in this, because this is where I really want you to be a tax strategist when you walk away from this presentation. So 5250. So let's say that you are in the 22% tax bracket times 0.22. This is a $1,155 tax savings. If you have a child that is in college and you put them on payroll, and you definitely can contribute $5,200 where you're paying towards tuition reimbursement, or if they have student loans and you're paying back using some of the $5,200 part of their compensation to go towards student loans, in addition to their actual compensation they're getting, and you're getting a deduction for that. All right. So I want to make sure we talk about that. And let's go through. All right. So what's going to take effect for 2026? This is going to be nice. It's going to be another above the line deduction. Do you remember during COVID and how they wanted us to be able to contribute to organizations? So I think they had like $300 you were able to deduct. $300 or $500. I think it was $300 or $500. I forgot. COVID was like 4 or 5 years ago. But on the 2020 return, you're able to deduct a certain amount of money that you gave to charitable contributions, charitable deductions. Well, it's coming back. Starting next year, not this year, in 2026, and when you file returns in 2027 for your 2026 tax year, your clients, single filers, will be able to take $1,000 deduction for what they give to charitable contributions. Now, when I look through this, it looks like it's just cash. I haven't seen anything say anything about non-cash, like giving clothing and stuff like that to Goodwill. But $1,000 deduction for single filers. It doesn't mention head of household filers as well. I feel like they left out the single moms and single dads out of this bill, but that's okay. But $1,000 for single filers, $2,000 for joint filers. So for the joint filers, $2,000 joint filers without even having to itemize. So think about this for a second here. Think about your elderly clients, your clients over 65. They're already getting a $6,000 deduction for being just over 65. Plus, not all their Social Security is being taxed. Plus, if they give the charity, that's $2,000 and not big. So, you're already reducing so much taxable income for your elderly clients that are over 65, for just clients in general. So this is a good bill, right? It's definitely going to be able to help out your clients as well. It's a good bill. All right. So that's some of the explanation that we got for that. Now, I want to take a few seconds to talk about business for a second, because a couple of things that I think that was helpful for business owners, in my opinion, is that the 199A, right, the QBI, Qualified Business Income Deduction, right, Form 8995. I think that was good because 20% of their profits, or 20% of their business income became a tax deduction. That reduced clients' taxable income. That helped for many clients. So it's definitely been adjusted based on the One Big Beautiful Bill Act as far as what's permanent, what's been enhanced around that. So still, it's going to be a new inflation adjustment for the One Big Beautiful Bill Act for the QBI deduction. So that's going to stay. That's not going away. Also, bonus depreciation is back. So being able to take 100% deduction for capital investments is going to be available for you. So your clients making big investments in equipment for their business. We're not talking about vehicles right now for the exact second. We're just talking about, equipment that they're purchasing. Maybe you have a client that's a, HVAC technician, or maybe you have a client that's an electrician or plumber and they buy, a digger or something like that, something to equipment for their business. Bonus depreciation is back to 100%. And now notice the date. I'm not going to say any comments. Notice when it has to take an effect. They place it in service after January 19th. I'll let you go and look and see why it's after January 19th. I'll let you think about that. Section 179 expensing is also enhanced for permanently increasing to up to 2.5 million. I think it could be Section 179 deduct. So Section 179, so that's where expensing of the capital assets that they acquire. So that's good as well. It's helpful for businesses. All right. All right. Energy. So we talked about the cars, right? And the $7,500 credit is gone, right? That ended September 30th. Another thing to take into consideration is I want to use this chart here. As a matter of fact, I want to use this chart since we're coming close to time here. I have a chart here that I want us to use. Okay, so on this chart, this kind of simplifies it. So on the chart over here, and the main thing for your clients, so the vehicle credit is gone after September 30th. Energy efficient home improvements. Now, right now, everybody's thinking about holidays and holiday shopping, etc. Whatever holiday you celebrate, people are out there buying gifts for that. No one's thinking about, hey, maybe I should get a hot water heater before the year is out, or maybe I should go get a new AC unit. Right? Nobody's thinking about that, right? But energy efficient home improvement credit expires on December 31st. You have about 3 more weeks, 2.5, 3 more weeks left of that to get the energy efficient home improvement credit. So that's something to take in consideration. You want to make sure you talk to your clients, reach out to some of your clients, do some tax planning, tax strategy, see how we're strategizing with the clients. Now, if you have a client, let's say you have a client that bought solar panels in 2023, and that credit has been rolling over every year because they haven't fully used it all. That's okay. It's still going to roll over. I think it was that form number, form 5695 or something like that. That's, that form is still going to roll over in your software until you fully use the credit. So that's okay. It's just that nothing new could be acquired after December 31st and placed in service, and they can get that credit. For those of you that have some clients that are contractors, general contractors, and they're building some alternative fuel vehicle, they're building energy efficient commercial buildings. Maybe you have some clients that are manufacturing certain items. They've got until June 30th before their energy credits expire. I've got the Internal Revenue Code citation over there for them to see that. I realized I flipped the order. This should have been on top and that should have been underneath it. All right, so coming back along over here. So that talks about our energy credits. I wanted to make sure we mention on that. Right. Okay, so I want to introduce you to a form. And a form I want to introduce you to. Well, wait a second. Does everyone know? My computer's freezing. 1 second here. My PowerPoint is freezing. Does everyone know what is cryptocurrency, right? And I think everyone pretty much has an idea, but I still want to take a second and just talk about what a digital asset is, because I refer to it as cryptocurrency, crypto, but the proper term is digital asset because there's other types of digital assets. So any digital representation of value that is recorded on a cryptographical secure distributed ledger, right? AKA or cryptocurrency, right? So we want to talk about that. So digital assets, right? Anything that can be converted to virtual currency to cryptocurrency, stable coins, NFTs as well, non-fungible tokens. So the IRS is treating taxes of cryptocurrency as property rather than true currency. So they're treating it as property. Now, you may have some techie clients, right? I think I was in Los Angeles last week, and you saw the little Bitcoin sign outside the stores, the corner store, whatever, the liquor store, like you could buy liquor with cryptocurrency. But anyway, but you see that, and the reason why I say that and bring it up is because you may have some people that may be using cryptocurrency not as just as an investment. Maybe they're paying people for the services. Oh, you took care of this, you built this app, or you developed something for me, or you did this kind of service for me. I'll pay you in crypto. So there's a way how this is being treated. Now there's a new form that's going to be coming out here, and this new form is called a 1099-DA. And the 1099-DA, this is what it's going to look like. Now, not everyone has to have it out by this year. They're giving, as long as these companies are trying to make good faith effort to try to deliver it out. So it's not required this year as far as it's not going to be enforced. But you may have some clients that may get this. And when you see this form, I don't want you to freak out. Like, what in the world is this? I want you to understand what this form is. So 1099-DAs, you may have some clients that may get 1099-DAs, and it may say the name of digital assets being used, data acquired, but it may have the basis as blank, or data acquired may not be fully available, right? Because clients move from one wallet to another, they may be transferring currencies to different wallets, right? When we say wallets, it's like different I don't want to use the word banks, but it's like moving from one bank to another, like moving from Bank of America to Wells Fargo, moving from different wallets like Kraken to what's the other one? Other ones out there, right? So they're moving to different wallets. So there may be information in regards to basis. This is why you as a tax professional can probably justify your rate increases, price increases this year. Number one, refunds are going up. Number two, you're going to have to strategize with clients to maximize those refunds. Number three, you may not get all the information on these 1099 DAs. So it may require you to work with that client where they have to log into their wallets and find out what their original basis was, what their basis means, what they paid for that asset or what it was at the time, to find out this information so you can legally reduce their taxable income. Because if this basis item is blank, that means that whatever the proceeds are, that's what they're going to be taxed on. And that's what the IRS is going to be expecting you to pay tax on. But if you could work with the client to get the basis, that will reduce what the taxable income is. So 1099 DAs are going to be coming out there. So I want to make sure I address that with you on what that looks like to you to see a 1099 DA and when that is coming. So you may see it this year. You may see some a little bit more in the next period. Now, I want to take one quick minute to talk about the Trump accounts, because your services that you're going to be changing, you're going to be doing additional services for your clients. So your package, right? Many of you got your package. Some of you are so organized. You got your packages inside the software and everything, 1040 package, 1065 package, 1120S package, etc. But your package now, the minute you're doing a tax return for a client and they say, yeah, my baby was born this year, right? You're offering another service. There's a form called Form 4547, right? It's named after the president, 45th and 47th president. That's the form that you're going to use to apply for their Trump account. Trump account is where $1,000 is going to be deposited by July 4th, 2026. $1,000 is going to be deposited into every single child that's born between 2025 and 2028. And then your way how your clients get that access, that $1,000 Trump account, is that it will be they'll have to fill out Form 4547. You will prepare it for your clients. Don't let your client go do it themselves. You do it, right? So that's part of your 1040 that you're doing for your client, the tax return, doing tax planning for your client, plus you're doing their Trump account application to be doing for their client as well. There's some information we have that's going to be coming in the handout about how this is going to work. But essentially, that money has to be invested into mutual funds or ETFs. There's rules and guidelines how that could be invested. Employers, you can have some companies will allow their the employee to contribute from their paycheck up to, I believe it's $2,500 from their paycheck can go into the Trump account. You can add in another $2,500. It's going to be after tax dollars, so not a tax deduction. But however, the account is going to grow. And what we're hearing from some investment advisors, that if you just the $1,000 never gets invested, not invested, if the $1,000 nothing else gets added to the $1,000, by the time that child's 18, that could be anywhere from $15,000 to $18,000 if the parents don't put anything else in there, right? And then when that child turns 18, that account becomes theirs. That's going to be their money that they can start off life with. So this is something that's going to be out there for you. There's a lot of information. Guidance just came out last week on what this is, but the Trump account is going to be big. Big program. It's going to take effect between 2025 and 2028. So that's going to be part of your package that you offer your clients. You will not be able to set up the Trump account until next year. That it's going to be something on the IRS website. So that's going to be coming out there for you on how to set those Trump accounts. It has to be invested in these different areas where you see it has to be invested. It just can't sit there in cash. And no distributions are allowed until that child turns 18 years old. All right, so let's stop over here for Q&A. Let's do some Q&A.
Wow. First off, I just have to compliment you. I have never seen someone go through that much information that quickly and that thoroughly. So thank you so much. We have gotten more comments than I even know what to do with how amazing this presentation's been, asking for recording. So we really do appreciate all your time today. As we're kind of going through, we have answered some of the questions. One of the ones we did get is...
If you want me to help out, Alexis, I can, because I've been kind of answering them.
Yeah, you go right ahead, Omar.
Yeah. And thanks again, Anthony. I've been kind of answering a lot of questions in the background, and we've been getting some good ones. A lot of them are really centered around a lot of them are about the tips. I think they just wanted a little bit of clarifications about how to report the tips. And we understand that if they're going to be reported on the W-2, usually under, well, all the time, I guess, under Social Security tips, because that's where you'll be able to find them. I believe that's correct, right?
Yes, that's correct. So the tips that the employee reports, it's going to be under that box 7 here. Sorry, my and it's moving a little bit slower. It's going to be on that box 7, and then you're going to scroll down to the bottom of that W-2 in your software and enter in that the tips number.
Which is, you'll get that and you'll report that on the Schedule 1A.
That's correct.
So what if they are self-employed? To my understanding, it's going to be a difficult. So what is your answer to that?
Fantastic. So if they're self-employed, you're still going to go over to the 1A form if they're self-employed, and you will enter in, there's a section over in the 1A for self-employed. So you see, like right over here for self-employed, you would enter that information over here, linking over to the worksheet. Oh, no, sorry, linking over the worksheet. You will enter that information over here under 1B. So if they're self-employed over here, if there's employees, it's going to be calculated field. See how this is calculated? Feel it's coming from that W-2, but over here, this is where when you click into that worksheet and then you work through on that Schedule C, you'll be able to enter what the qualified. Oh, I'm on overtime. I'm sorry, I'm on the wrong box. I meant to go on tips. Here we go. Under the tip section, box 5 over here is where you're going to put in if they're self-employed.
Got it. So what they would actually have to do a little bit more work on the self-employed part, either because they're not necessarily going to be on the 1099 forms or any of those forms. I mean, maybe it's easier with like Uber drivers because they can run easy reports, but if they're not necessarily have a system in place, they would have to kind of manually keep track of that, correct? Like a log, similar like mileage or something like that.
100% correct. Yeah, it's 100% right. Because if your client gets audited, they will need to have some documentation, but they're showing where they got the tip. So you, as a tax strategist, are going to work with your clients to create a system to audit proof them, right, on how they're reporting their tips on a regular basis.
Okay. Perfect. And we got a lot of questions, which I answered, and I'm pretty sure it's correct that it's only for the interest on cars is only for new cars purchased, not used cars.
That's correct. It has to be a brand new vehicle, and you will need to put the VIN number in on the form over there on the Schedule 1A page 2. Let me bring it up over here. It has to be it's for brand new vehicles, and they're going to put that VIN number in. Yep, okay. That's correct.
Okay, great.
Assembled in America. Assembled in America.
Oh, and assembled in America. That's another requirement.
All right. What else we got?
Can you use Schedule C, Schedule 1A? That's correct, because you have to use the 1A to report your tips. And let me see. I did answer the rest of them. Review of Trump setup account, how account is set up. I guess is there information we can provide them on that handout?
They don't have the site up yet. It's going to be, let me bring up the PowerPoint here. They don't necessarily have that site up yet because some guidance just came out on it. As a matter of fact, and there's a PDF that I have of it here. See if I can find that PDF, but some guidance just came out on it. So they don't necessarily have the site up yet, but it's going to be coming out next year. And I want to encourage you to make that part of your service. Yeah, here it is right. This guidance came out last week. So they'll receive it through Form 4547, an online tool once available. So not available yet, but the deposit is going to take place before July 4th. So any of your clients that have, let me bring that back up on the screen. Your clients that have children that had children born in 2025, that will need to go. They'll need to do the Form 4547, excuse me.
Okay. People really like that, and that's something people got really excited on. So thank you for sharing that. As far as, do you see with all these major changes and them having to keep records on the tips and everything that, for example, self-employment, do you anticipate that they'll have to do additional due diligence questions to be answered for those credits?
Yes, absolutely. Yes. Due diligence such as overtime, diligence on tips, diligence on children being born, due diligence on new car purchase, due diligence on their age, making sure you know the proper age, tax planning. Okay, when this person does turn 65, this is going to be the year you want to take the time to really understand the Schedule 1A, understand the Big Beautiful Bill Act, and have your question prepared. Know what to ask that client before they come in the door, because this could lead to additional tax savings for that client.
Do you know if they're changing the due diligence forms in tax-wise for those changes?
No, not for those. Well, some of the forms have been changed as far as the tips on the W-2. That information is there, inquiring on that. But as far as the question, we're not asking the question right now, like, to give your last pay stubs. This is kind of using logic. So if you still want to include, we haven't changed the interview worksheet to incorporate that. When you see how it says wages, salaries, and it says yes, you kind of want to use your kind of thinking and thought around that. Like, okay, you see how it says tips? So tips has changed. So number two has changed. You have tips. That has changed. But as far as, do you have any overtime pay or something like that? That hasn't necessarily been added to it. But that's something that you want to add in your questions when you ask clients.
Okay. I think they're referring to the due diligence for credit, where you have to answer the earned income credit due diligence. That escapes me. Because every time you get a credit in tax-wise, you have to go back and answer the questions like, how did you gather this data that required due diligence? So we're just, the 8867 form.
I'm not aware of any changes to this, because when you think about it, really the nature of this form is the same, right? AOC is going to still be there, earned income credit, head of household, child tax credit. Some of these changes, there's not necessarily impacting, does this person qualify for head of household has changed, or this person qualifying for child tax credit has changed, just the child tax credit has increased.
Correct.
But it's not, the nature of that hasn't changed. So it's not necessarily going to be here where your due diligence is going to be changing, not necessarily on this form.
Correct. And it's probably because they're deductions, not credits. So
that's correct.
And the same credits are staying the same. They're just increasing. So it's not going to change the nature of how you qualify for the credit. It's just you're going to get more of it.
Sure. Absolutely.
And guys, so sorry. I just want to go ahead, let you guys know, I have seen a couple people raise their hands. We are not going to be doing live mics today during this webinar. So if you have any questions, please go ahead and open up your Q&A box. And there you can type any questions that you have, and we'll go ahead and go through those. You should see that on the left-hand side of your screen. Thanks.
We're getting a lot of questions on how to handle like these changes, like how do I charge for this? I have to come back for an appointment. This is all up to the tax preparer, I believe, correct? I mean, that's something that if we can definitely have a chat open on either our Facebook group, or send us an email or call us. We can kind of help you come up with a good plan of service. But that's something you want to figure out on your own, on how you want to handle that process yourself. How much you charge for it, that's up to you. When you charge for it, do you include it at the time of tax prep? Instead, all that is up to you.
Yes, absolutely. That's correct. You want to be wise in your decision on how you price out your services and your time, and be proactive, right? If you know clients are going to come to your office with their W-2, they're going to take their W-2 out their pocket, put it on the table, say how much I'm getting back. Reach out to those clients in advance. Say, here's a checklist of things you may need to bring to the tax office, to your tax appointment. Be proactive so you don't have to wait for clients to come back. Because the more proactive you are, the more they can bring information up front, the quicker you can finish the return, and quicker you can get paid. And
the last thing you want to do is start doing more work without being prepared for it, because that's how, you want to definitely be able to use this to increase your revenue, not end up doing more work for less money. So definitely pre-plan for it and get all the information you can as early as possible. We got a series of webinars this year for tax. We're going to have another webinar for tax-wise changes that's software related, that just digs directly into the software. This is more directly with the tax law changes only. And I know Anthony did show you some of the changes with the 1A. I do have a good question here. I don't know. I'm assuming it's probably not going to check, but maybe and we can probably ask it on the next webinar, is will the system reject it if the car is not made in the US, or if it's the wrong year? Maybe there's some checks, but not all of them, I'm assuming, because if you put the wrong year, it might reject, but I don't know if it's smart enough to know if the car is built in America or not. Would it?
That's something I'm not sure of. That I'm not sure if they've got that built into their e-file system yet. we haven't e-filed a return yet with that information, so we don't know yet. But I would just make sure you proper do your diligence so that the client doesn't get a letter in the mail from the IRS.
Correct. I'm sorry. That car 2025 deduction, the car has to be purchased in 2025. It has to be a car that was year model 2025, or can it be 24? You bought it in 25? Is it that strict?
It's for brand new cars, 2025 brand new vehicles. For 2025 brand new vehicles assembled in the United States. That's what it's for.
So even if you buy a new car, that's it's still a brand new car, but it was a 2024 model that just ended up staying on the lot until 2025. It still won't qualify. It has to be produced in 2025.
Yep, that's the incentives. Yep, that's correct.
Right. A little tricky there. So definitely one. Okay. Alexis, do you have anything else that you've been answering? I think I'm good.
Let me look. I think we covered almost everything. You guys have thrown out a lot of great questions. We can't thank you enough. I'm not seeing anything that we've really missed.
Great. And we're here, everybody. If you have any follow-ups to us, feel free to call us. We're going to have a recording of this posted and sent out to you, as well as the handout. And then make sure you sign up for the remaining webinars just to tie all this information together.
Yep. Our next webinar is going to be this Wednesday at 2 p.m. Eastern Time. That webinar is going to be with TaxWise Wolters Kluwer again. That one's going to cover all of the new changes for the 2025-26 software. So that's a really important one as well for you guys to be on.
Yeah, that's a good one, definitely, because that will go into the software specific versus the law specific that we did, everyone. And a huge turnout. Wow, I'm really happy that everyone turned out to this. It was a very good webinar.
All right. So does everybody feel like tax strategists? You feel like you're going to be tax strategists this year and not tax preparers? I hope you feel like that. I hope you're ready to do that. Fantastic. With a thumbs up, I hope so.
Yeah, they sure are.
All right. Well, pleasure to meet you, everyone. And you all have a wonderful day. Thank you so much for having me.
Thank you so much again. We look forward to this again next year.
See you all.
Thank you. I'll take care.
All right. Bye.